Hey everyone, welcome to Retire with Style. I'm Wade, and I'm here with my trusted co-host and companion, Alex Murguia, and we're continuing our series on the Q&A questions that came in. And Alex, I think you're wearing the same clothes as last week. Is that your new favorite shirt?
Yes, it reminds me of you, so I wear it all the time. I wear it all the time.
I'm
It's
wearing
very luxurious. So I just like to I'll leave it at that. Plus, the stripes are very slimming for me, and I need all the help I can get. Yes.
Yes.
You're wearing the same shirt too,
like
eh?
you're 20 years old.
What's up with that?
Got a favorite shirt too. So.
Really?
And it's now the middle of the summer. You probably should be wearing short sleeve shirts, but you've got your velour for July, I think.
Yes. Christmas in July, why not velour? That's the way I see it. All right.
These muggy Washington, D.C. summers.
Yeah, right? Yeah. All right. Let's get to business, Wade. Come on, man. You're always bringing this down with chit chat.
Too much small talk. We've got another 3 questions that I thought we were going to get through the whole rest of the questions last week, but we had so much discussion on 2 questions. We'll just kind of see where the winds take us here.
Huh? Rob's pretty good.
Yeah, he's wonderful, and he's our resident expert on executive compensation for employees.
You scared him away. I said, "Hey, Rob, you want to do the next one?" Nah, you guys do your thing. I'm busy. I think that was you, man.
I'm gonna have to carry on here. It's too much small talk in the last episode.
All right, question. I'll read it. Here we go.
Be more dramatic with your reading this time.
Let me see if I can do a good job. Let's hear. Let me see how I do.
Think about Shakespeare.
And I'm not reading these beforehand, so let's just knock it out. How, if at all, should a recent or near retiree think about their portfolio in a world that you can get low 2% real yields on tips from 5 to 30 years? While perhaps a real yield at this level is still low versus real equity returns, it seems to provide a floor on returns and can mitigate investment risk and inflation risk better than this product would at almost any time in the last 20 años.
20
years. Yes, thank you.
How was that? Simultaneous translation.
How was that?
No, that was a wonderful reading of the question.
Thank you.
Yeah, and this is something that I think about a lot. It's an important point, and it's not not the reading, the question. the issue in the question. The fact that tips yields are well over 2%, at least, of course they fluctuate, but as of the time of recording, 2.3% real interest rates on tips are not at all out of the question. So if you've already won the game, why keep playing is kind of the issue. I know that phrase came up in a previous episode from William Bernstein.
They were
maybe from a different question, but
it was during the YouTube live where you were talking about the funded ratio, and we're talking about like a 115 funded ratio. You kind of like are locked in.
Yeah,
and the question was, well, I don't know if it was like they were making fun or they were serious, but it was almost like a comment of, so you're telling me just put it all in tips now? It had that kind of vibe to it.
Mm-hmm. Okay. You're going to be more funded when interest rates are higher if you're a normal person whose liabilities are more backdated than their assets. The only real exception to that might be if you're expecting a huge inheritance in the distant future, higher interest rates might lower your funded ratio. But for the typical person, your assets are more front dated because a lot of them are just account balances. The present value is the value today, whereas the liabilities are more back dated because it's a lifetime spending goal that's going to run through age 95. So when interest rates are higher, you'll be more funded. So at a 2% real interest rate, your retirement's going to look a lot more funded than it would at a 0% real interest rate, which was kind of where we were. There's been points in the recent history where 0% was optimistic about a real rate of return that's risk-free. Now you can get well over 2%. So what do you do with that information is ultimately the question. And yeah, I don't think this is an issue. It's not market timing. It's not saying interest rates are higher than they'll ever be and therefore put everything in tips or anything like that. It's more, if you can meet your retirement spending goals with tips, that impacts how much risk you might want to take in your financial plan.
I think the phrase "income is the outcome" is the way to go. If this provides you the ability to live within your standard of living in retirement, it seems like a good deal, frankly. I mean, there could be some tax considerations. Is it all in a tax-deferred account? Is it all in a taxable account? And how does that play off? Since tips are somewhat a little more inefficient in a tax, not a little, but they're inefficient in a taxable account. Do you have the cash flow to pay the taxes, et cetera, et cetera? But to me, I remember when tips had come out, I want to say it was even around like '01 in that range. And they were extremely high, the tips rates. And I remember.
Yeah, when they first came out in 1997, you could get over 4%.
Yeah, so it was before like '01. And I remember I think it was Bodie of all people that said something along the lines of, why wouldn't you just log in on this and call it a day? Because any person that you can offer a rate this high to fund their retirement, it seems like a no-brainer. And I remember at the time thinking, man, this guy is boring. Like, where's the fun in that? Kind of thing. Honestly, I remember thinking that. And then boom, you had the stock market crash, the bubble collapse, Enron, all that kind of malfeasance. And it struck me for whatever reason a couple of years after that, thinking, man, this guy was right. All of a sudden, man, Bodie really had it locked in, right? And so to some extent, I think we're in that kind of strategy now. Not in strategy, that's the wrong way. But we're kind of in that milieu right now where tips are quite high relative to what you've seen historically. And if it fits your style in terms of time segmentation, if you're able to do that and maintain a standard of living that's very comfortable for you, there's a lot to be said for that game and locking it in.
Well, and to be clear, I don't think either of us are suggesting put all your money in tips, but it's more everything else being the same. Tips look a lot more attractive at 2% plus yields than they do at 0% yields. And so whatever you might have done in the past relative to now, taking some of that risk off the table with tips is a lot more attractive now than it was in the past. It's not saying you should put all your money in tips. It's just saying it's more attractive now than in the past. And so if you want to have a higher allocation, it's back. We talked about this as well in the past, is when you're with your funded status, you kind of take the least amount of risk right around when you're perfectly funded. Then as you become overfunded, that surplus is more surplus wealth that you can invest more aggressively because it's not needed to maintain lifestyle. And that's kind of the situation here with the higher tips yields. You're going to have a higher funded status, which means you'll have more surplus wealth. So you can lock in more of the basics and then invest that surplus in a more aggressive manner.
And if I wanted to put some planning parameters around that, I would say this. Yeah, not 100% on any, that kind of stuff. Other than Pokemon cards, I wouldn't put 100% on anything. But effectively, look at your essential expenses. Consider your Social Security income from that, or if you have pension income from that. Figure out how much do you cover with that from your essential expenses, and try to get the next level of. If you have this sort of proclivity, then try to look at the next healthiest amount you can put in tips to cover essential expenses with. That to me would be the reasonable slug that you would want to be looking at. That's how I would handle it from a pure financial planning perspective. It's a funded ratio. How much of your essential expenses are covered from reliable sources already? What if it's 80%? See if tips can cover the remaining 20%. That kind of thing. Wade?
Yeah. I think I've had my say on this question.
Okay. Should I go see if I can go 2 for 2? Problems. See if I can go 2 for 2 on my
your dramatic
monologuing.
All right.
All right. Let me get in character. What percentage would you recommend for a couple to have assets in taxable, tax-deferred, and tax-avoided accounts? My thoughts, it would be best to have a third in each. Currently, my own retirement saving is at 33% taxable, 49% tax-deferred, and 17% Roth. Because we didn't have Roths until later in our career, they are the lowest. our estate will go to charities. So when we die, damn it, I almost had it. Our estate will go to charities when we die. So it is not the traditional leaving it to children. This may make a difference in how you look at it. Take it away, Wade.
All right. Yeah. And so this general point about like, is there some sort of rule of thumb that I should maybe be for tax diversification? I want a third taxable, a third tax deferred, and a third tax exempt. I think you really have to move away from that kind of thinking because it really doesn't apply to retirement. Because of the withdrawal order sequencing, your goal always becomes to spend from the taxable account first. So you're effectively pushing the taxable account towards zero on purpose. So you don't need to have it be a third necessarily at the start of retirement. Another thought is, yes, this point about the legacy going to charities rather than to adult children is a relevant factor because it means you're not necessarily going to be thinking about Roth conversions from the perspective of, because you have to consider if your children receive an inheritance in their highest lifetime tax brackets, you want to offset their taxes. Any money going to charity, the charity will pay at a 0% rate. And so you never really want to do a Roth conversion on funds that'll go to a charity. The only reason you might consider Roth conversions is for your own tax planning to help reduce future RMDs, which the RMDs, if they're going to trigger things like the IRMA surcharges and so forth, that could be a reason still to consider Roth conversions. But with the idea that the money will go to charity, and if you already feel like you're overfunded, you may also think about things like qualified charitable distributions to get money from the IRA to offset the need to take the RMD. That could be another way to avoid those sort of tax implications. So that because the charitable intention for legacy, there may be a much weaker case to even consider Roth conversions. So this idea that they were a third taxable, half tax deferred, and then the rest, the other sixth, is in Roth. They don't necessarily need to work towards changing that from where it is right now. It's more the money in that tax deferred account, whatever ends up going to charity will go at 0%. They could do Roth conversions to help with RMDs in the future, but also if they're funded for retirement, I'm pretty sure they're going to have some legacy. They can offset the RMD problem by using qualified charitable distributions at that time. I think they're generally in pretty good shape and not necessarily needing to do a whole lot of specific tax planning. They are going to think about spending the taxable account first and then just blending from tax deferred and tax exempt for the subsequent part of retirement.
I agree. I would. You've answered the blocking and tackling part of this question, but when I read this too, I'm picking up on this theme that I'm also seeing, let's say, in social media. And I kind of scroll through Twitter. I'm kind of more of a drive-by Twitter person and the like, and even on YouTube, I see a lot of this movement, especially pre-retirees, about tax diversification. This idea of tax diversification, and you should have a taxable amount, a tax deferred amount, and a tax free amount that's kind of a third, right? That kind of stuff. Like if there's some benefit to it.
And just to be clear, the goal of tax diversification, it's never as simple as a third. If that's something you're seeing on YouTube or TikTok or whatever, that's kind of a weird way to approach tax diversification. It's not that simple, but please continue.
Yes, thank you. Are you done, Wade? Are you done? No, you're right. You're right. It's just one of those, right? But I would say this. There's a practical reason why you may not want everything in a tax deferred account or a tax free account. And from my own personal standpoint, you kind of want liquidity as you're accumulating. And so I've been fortunate enough that I can max out tax deferred and this and that. But let's say if I didn't, I'd probably just leave a little bit in taxable anyways for just liquidity issues. Buying a car or something that's like 10 years away, 15 years away, and you're still going to be pre-retirement, you kind of want to have it on you, right? It's not necessarily a buffer asset unless you had it in like cash or something like that. But there's reasons for just having taxable accounts handy, right? But that's, again, financial planning, having it handy, convenience, if you will, because you don't want, you want to be, it's like being house rich but cash poor, to some extent. When you're in your 30s or 40s, you don't want to be like 401k rich but cash poor either, right? And so there's a little bit of a exposure that you would want, but that's about the extent that I would think, oh, I need this great tax diversification, because Wade is 100% correct. When you get to that distribution phase, there's an order of operations of how you want to distribute, and the tax deferred and tax free are very valuable accounts, and so there you have it. And so the way I would look at it, these are one of these things that there's nothing there for the most part. And I would suggest live your life as is, make reasonable contributions to your Roth, make reasonable, if you qualify, make contributions to tax deferred if Roth isn't available. And then if you can have something left over to invest, yeah, do so. That's beyond just a cash account, because it's helpful during life's slings and arrows while you're accumulating to be able to have something you can tap into. But you don't always just want to leave it in cash. And then when you retire, whatever it is, it is. It doesn't have to be more complicated than that. I would not go through the trouble of trying to be precise and making it a third. I personally think it's a big waste of time. It's almost like asking someone to paint the walls a 10th time just for the hell of it. It's almost like busy work that you don't need to do.
Well, and it also may lead to inefficient decisions, because it's like, if it stops you from saving, because you'd have to put it in your taxable account, but that would make your taxable account too big relative to the others. Tax diversification is a nice to have, but it is more of a secondary consideration. It's important to open a Roth at some point, because you need the 5 years of having a Roth account open before you can get qualified distributions from it. And it is nice to have diversification, but first take advantage of tax advantage savings space, have a basic Roth, but then figure out, based on where you are with your income, should you contribute to a traditional account or a Roth, comparing today's tax rates versus where you'll be in the future. And then beyond that, you want some liquidity in a taxable account, but your surplus savings then goes in a taxable account. And if you're a big saver and you're filling up the tax deferred and tax exempt space, you might end up with a much higher percentage in the taxable account. And that's okay. Tax diversification just means having some of each. It doesn't mean equalizing the amount of each.
And that sum in the taxable is kind of quasi enough for like expenses, if you will. I would say that what happens, Wade, and this is not for this question, but it comes up. I'm amazed how many advisors on social media are very religious about this. And, you feel like responding, don't be an idiot, kind of thing, but you let it go, because who has time for that? But what is your take on somebody that would say, yeah, but look, I have a taxable, I'm going to actually maximize my taxable account because I'm not a trader. I'm not going to touch this money for 30 years. They think, but whatever. If I need it, I can, but I'm going to leave it alone for 30 years. Let's just say 20. I'm going to leave it alone for 20 years in an index fund that's low cost and low internal turnover. So I'm not going to get these taxes on a year-to-year basis on dividends and things like that. Versus
dividends, you will.
Yeah, well, but you know what I mean. It's going to be minimal. It's going to be minimal taxes. I'm not going to trade it. I'm just going to leave it there. And to me, that's going to be better when I retire, because I'll just pay capital gains. I won't pay the income on the IRA or 401k.
Yeah, well, that's an asset location point, right? The tax efficient growth assets tend to go to the taxable account. The lower returning, less tax efficient bonds and so forth tend to go to the tax deferred account. And then the less tax efficient but higher potential return type assets, small cap value, that sort of thing, tends to go in the Roth account. And that's asset location. Asset diversification or tax diversification, you want some just to create more flexibility with being able to generate retirement income in a manner that doesn't force you to have negative tax consequences. So you want some money in a Roth so that if you need a little more spending power, but if you took it from the IRA, you'd have to pay a Medicare surcharge, so you can source it to the Roth. That's why you want the tax diversification. But you just want some tax diversification. Again, you don't have to worry you save what you save. Don't worry about the exact percentages in each type of account. Just focus more on asset allocation, asset location, having some diversification, and having a good basis then for retirement.
So this is effectively one of these points that in the grand scheme of financial planning, don't worry about being overly precise. Just get a healthy exposure to the variety of these three accounts. Specifically from the taxable, as you're accumulating it, it's good to be able to dip into it every once in a while if you need be. That's all I have to add. And then when you distribute, it's good to have deferrals and tax-free accounts for the reasons Wade just mentioned.
Especially the Roth accounts. That's the maximum flexibility of being able to cover spending needs without having anything go into your adjusted gross income, which creates all the secondary, the Social Security tax torpedo and Medicare IRMA surcharges and so forth.
All right. Last question.
And it's the shortest of these questions.
Well, but it's the shortest, but interestingly enough, this could be a nice answer because it covers some of the research you've been doing, and it kind of, I want you to me, I'm like, you see, Wade, Wade and I have been in the back, behind the scenes. There's a study that we're doing right now, and we're going to see how it turns out. And it's about what are some optimal allocations with annuities from, for defined contribution plans and things like that. If we had to determine defaults and things like that. And so here, this question is interesting. What is the optimal retiree asset allocation model portfolio, assuming life annuities will be replacing the optimal bond portion? For instance, in a 60-40 stock to bond portfolio with 40% in life annuities, how should I invest actual products, in parentheses, the remaining stock portion of my long-term portfolio?
Yeah, and so this question, I think they're making the point I agree with, which is the efficient frontier for retirement income is stocks and life annuities versus stocks and bonds. So you're allocating your bonds into protected lifetime income sources, and then you don't touch your stocks. But then I think this question is getting more at, well, given that I'm doing this, like, how should I actually invest in the stocks?
For our readers, why would this even be a consideration? Okay, this person is, yes, he's checked the box. He wants to do this. But for our readers, why should annuities be introduced into the efficient frontier, if you will? And what role should they play within the stock to bond, dynamic?
Yeah. So that's the whole, like, if you take a simple income annuity, your premium goes to the insurance company. They put that into their general account, which is mainly a fixed income portfolio. So you're effectively, they're investing your funds in bonds. There might be a small equity allocation, but it's bonds with, like, they're able to take some premiums that households struggle with: longer maturity, less liquid, a little bit more credit risk, institutional pricing, because they're such a big player in the markets. They might be able to generate a higher yield, and then they offer you a lifetime income payment that will be higher when interest rates are higher because they'll earn more interest in their general account. And then at the same time, the longevity or mortality credits, those subsidies, if you end up living a long time, more and more of your income comes from those who ended up not living as long. And that allows annuities to support higher levels of spending than bonds. So it really becomes a workhorse for supporting spending in retirement, puts less pressure on your other investments. And so when I have this protected lifetime income, I have more reliable income, I have more risk capacity. My lifestyle is not as vulnerable to market volatility. I've got my lifestyle covered, or at least my essential spending covered. So I can potentially take more risk with the remaining investments. And that's really the story why you're not necessarily selling stocks to purchase the annuity. It's more you're replacing your bond allocation with the annuity. Now, you might need some bonds just for the liquidity, for contingencies and so forth. But otherwise, your stocks are more for discretionary types of goals. And so you've got stocks and life annuities. Okay. Now, that being said, how do you invest the stocks, and that in parentheses actual products. So
Okay.
in this format, we can't speak about specific products. That's part of the regulations. We have to
No,
keep it
no, no, no,
educational.
no. So wait,
But,
wait, real
or
quick.
asset classes, maybe.
Just because this person said life annuities, I didn't, technically that's not a real term. What do you think?
That's another term for income annuities.
There you go. Income annuity. And now,
C as in D is.
how do you think about that versus the other types? If you would introduce the fixed indexed annuities or a RILA with living benefits, does your equation change?
No, it's the same story. Assuming we're talking about with the living benefits. So
Exactly.
an index
That's
annuity
what
with a
I'm
lifetime
trying to
income,
get at.
guaranteed lifetime withdrawal benefit, a variable annuity with a guaranteed lifetime withdrawal benefit. It has different implications for what the contract value might do, but if you just treat the living benefit as a protected lifetime income stream, the conversation becomes the same. You can think of that more as a bond replacement in the overall allocation, so that you're not messing with your stocks.
So the key is, if it's not the SPIAs, DIAs, whatever it is, there's a living benefit to it. Hence, you have that floor.
Yeah, and then does that mean you now, whatever stocks you would have had in a 60-40 stock bond portfolio, you'd have a different set of stocks with a 60-40 stock annuity portfolio? I don't think that necessarily really impacts. You're still, whatever stocks you're going to hold, although I guess that's coming more from the passive investing perspective of you just, the total stock market index is whatever you have in stocks, you want to be well diversified with the total market index. There is some research around like just the longer the time horizon, the more kind of you might go towards the emerging markets or the small cap values that are more volatile but tend to have higher returns. I mean, longer time horizon. We're talking 20, 30, 40 years. It may take that long. So you might tilt that direction a little bit with higher risk capacity, but otherwise, generally speaking, this decision that we're talking about in this question doesn't necessarily impact the specific stock investments that you're choosing for the stock side of the ledger.
Yeah, it doesn't, but I would say focus on capturing market risk, and you do that with a total market portfolio. Within that, what decision trees, and again, we're not actually naming products simply because this is just not the forum for something like that. Wade and I are managing principals of McLean Asset Management and the like. Many people that you hear on podcasts or whatnot, or not many, but there are quite a number, and they're not registered investment advisors, so they can spout whatever silliness they want, and they don't have like compliance or anything like that, which mistakes are made, when you do stuff like that. But ultimately, there's inflection points, decision points you want to make. So active versus passive, I wouldn't bother with active because I'd rather just go to Vegas or something like that. So, and that's my own preference. Now, when it comes to passive, you want to ask yourself, you want to get market exposure versus fixed income. You want to capture that market premium. You do that by simply buying a total market index. Within that, since it's market cap weighted, you're going to get really a large cap blend exposure. So that's the first decision, right? How much stock to bonds? This one, annuity to market. So you get the general market. Now within the market, you get your slug of just general market exposure, and then, as Wade said, there are premiums to be had, but they're not all the time there because it's a risk story. At least in my interpretation, they're more risk. That's more of a risk-based story. So you're not going to get these premiums every year within certain sections of the market. If not, they'd be arbitraged out. And so what are premiums? That, to me, makes sense to tilt your portfolio towards. There's value premium stock. So what that means is there's the market, total market, then value stocks, a value index. Not value in terms of Coca-Cola is a valuable company, but value based on accounting metrics. All right? So there's that. There's price to sales, price to book. They're all more or less the same. People tend to focus on price to book valuations because they're more consistent, if you will, and out of sample, they seem to work well. But there's that, right? There's the value premium. So you want to get a little bit tilt towards value. Another factor in explaining the variations of stock market returns is a tilt towards profitability. There used to be what was called that small cap effect, where small cap stocks effectively had a premium over large cap stocks. Further research has indicated that's usually the cause of, within the small cap stocks, there's highly profitable ones, that have a bit of a value tilt. And if you focus on profitability with that value tilt, you get that profitability premium embedded in it, right? And so you could do that with small cap value, as Wade had explained earlier. How much? It's beyond the purview here, and Bob and I will get into that with Wade as well as we get into a further investing arc in portfolio construction. But when you have total market, you want to have value exposure, you want to have small value exposure as well. Small cap blend, not as much as we used to recommend, simply because I'm not sure that's an actual premium to be had. I think small cap stocks, it's one of those that over the long term, you can make the case maybe they do, maybe they don't. And if they do, it's usually because the profitability is kicking in, not because of their technically just small. All right. There's also momentum, but momentum becomes a difficult play within the market. It can help you from like avoiding losses as opposed to avoiding losers. It can help you in terms of from an emission standpoint as opposed to a commission standpoint, simply because it gets very expensive, just trading on momentum. And so from that standpoint, again, where are we? Total market, value exposure, small cap value exposure, to a lesser extent, small cap. REITs are an interesting place simply because it's a different breed of stock from the market. So there's REITs. And then you get a similar representative sample of those asset class exposures on the international side. How much? I personally don't like to do the actual representation of a global market index, simply because I live in the United States and I'm more worried about what's happening here. And to me, that's more relevant from a currency exposure, where, as those stocks get translated back here. So that's the best generalized answer I can give when it comes to that. Wait, any holes in that I didn't get to?
No, I think you covered that well. So that's really how you want to think about the stock side of the whole equation. And it's not going to be too much impacted by this particular choice, except that you may just have a longer effective time horizon with what's left. So.
Yeah. I mean, the only thing I would add to that is I've seen a lot, and we saw it in the last episode, or was it this one, where, the rest is invested in Vanguard and growth indices. To me, what about growth? What about the growth index? They've been hot.
You went off on that in a past episode.
Okay, I'll do it right. They've been hot lately. Technically, you're paying for the privilege of investing in growth stocks. And so the expected return on that is actually not necessarily a premium to value over the long term. I'll just leave it at that, since I've discussed it previously.
All right. And that will conclude our Q&A episodes. So thanks, everyone, for sharing your questions. And we'll come up with another arc on a retirement-related topic for the future. So please stay tuned and join us with Retire with Style. Thanks, everyone.
Thank you, and we'll catch you soon. And Wade is in vacation at this point. I don't know if you're back.
So I'm back from the trip. So
all right.
Ready to get going here again.
All right, everyone. Take it easy.